Hello there, I'm Amira David. This is Boom Bust, and these are the stories we are tracking for you today. Tech giant Apple has filed a new appeal in its case against the FBI. Plus, Russian oil producers have agreed to freeze oil production. But is that global supply deal falling apart? I've got the details on all of that coming right up. Then we'll tell you why Democratic presidential candidate Hillary Clinton is now vowing to go after embattled drug company Valiant Pharmaceuticals. We've got her stern remarks straight ahead. And in today's Big Deal, Ed Harrison and I are talking about corporate earnings. They're dropping the most they have since the financial crisis. What does this say about the economy? And furthermore, what does it say about where we should be investing right now? We'll discuss that and a whole lot more on today's show. Don't go anywhere. Boom Bust starts right now. Tech giant Apple has just taken another step forward in its fight against the FBI. The company has filed a formal objection to the order that was issued by a federal judge calling on Apple to help the FBI hack the iPhone of one of the San Bernardino killers. The Department of Justice says Apple should help law enforcement on what it considers an isolated request. But Apple says this amounts to creating a quote-unquote backdoor, allowing law enforcement access to not just one iPhone, but all of them. We spoke about that with one of our guests, Carl Denninger, publisher of the Market Ticker. Take a listen to what he had to say.
The question is whether or not Apple can be compelled to perform some kind of labor that it doesn't want to perform. The All Writs Act, which is what the FBI is attempting to use to justify this, is a law that predates the 13th Amendment, and so the 13th Amendment would supersede it. And in addition, that's a constitutional amendment as opposed to just a statute.
So this is very much a legal question, as you heard him say. Now, the appeal comes just a couple of days after a judge in New York ruled in favor of Apple in a separate case in which investigators wanted the company to unlock an iPhone of a drug dealer. The judge in that case said what the government was asking for went too far. And while it will have no legal bearing on the outcome of the current FBI-Apple battle, the tech company, of course, is hoping the judge will be persuaded by the decision. Okay, moving right along here, Russian President Vladimir Putin now says that domestic producers have agreed to keep this year's oil output in line with January levels. It's the first time the president has stepped into the conversation on a potential global deal to freeze supply. An agreement has been on the table since mid-February after OPEC and non-OPEC members agreed it was time to try and stop the bleeding of falling oil prices. Keep in mind, oil is down more than 70% from its peak, driven by an oversupply exceeding 1 million barrels a day. But despite Putin's attempt to put this deal in motion, it's seemingly still hanging in a balance, with Iran refusing to jump on board and now Saudi Arabia pulling back on its support. In fact, reports surfaced last week that Iran's oil minister had called the production freeze, quote, laughable. When the deal was first announced a couple of weeks ago, we spoke to Marin Katusa of Katusa Research, who said then that the deal was a no-go. Take a listen.
I don't think it's going to happen. The agreement, what this would do, it actually prop up the prices for the North American shale producers. So that's the last thing Russia and Saudi Arabia want. Iran is not going to agree to this. Venezuela is a non-starter, so I don't think it's going to be a big issue.
Seems like he was onto something there. As a result, OPEC is heavily concerned about Iran's output rising even further, with inside sources saying the producing body is very unlikely to cut output at its next meeting in June. All right, well, Democratic presidential candidate Hillary Clinton is seemingly taking a page out of Bernie Sanders' playbook. Clinton now says she's going after big business. Well, one big business in particular, Canada-based drug company Valiant Pharmaceuticals. She's calling out the pharmaceutical giant for its alleged involvement in predatory pricing. RT correspondent Alex Mihailovich is in Toronto. He's been following this story. Alex, now before we get into what Clinton said, let's talk about Valiant Pharmaceuticals here, because with or without her comments, this is a company that's seemingly in trouble, right?
Oh, that's right. Talk about kicking a dog when it's down. $346 was the value of their stock last summer. They're hovering around $90 Canadian now. That's about $65 US. Drop in of $6.55 yesterday alone. So this company is taking a few hits, and you ask yourself why? Well, guess what? They're under investigation from numerous sources, including a couple of districts in the States, Congress, as well as the SEC. Now, the SEC basically notified them that they would be under investigation in the fourth quarter of 2015, and Valiant decided not to tell anybody. So transparency is an issue. Also, the fact that they're being investigated internally, well, you know that there's trouble within when you have an investigation going on within your own doors. So a lot of talk about that. This stock has tumbled quite a bit, and will it recover? Well, you have Hillary Clinton also adding to it. It looks like they're in a lot more trouble than they thought so in the first place.
Yeah, absolutely. The market just responding to all the political pressure. And as you mentioned, Hillary Clinton now zeroing in on this company in a political ad, as far as I understand. What can you tell us about that?
She calls it predatory pricing. I call it price gouging. This company is involved in that. So, this is a huge thing. This is not the only pharmaceutical company. She's choosing the pharmaceutical industry to be her Wall Street. Bernie Sanders is after Wall Street. She's after the pharmaceuticals. Now, these guys, if you watch the commercial that she put up, she's claiming that one person, an individual, this woman that's actually in the video itself, that she used to pay for $180 for her medication back in the 1980s for the same 10 vials of shots. Now she has to pay $14,700. How true is this? Well, you have to really dig a little bit deeper. But any way you look at it, price gouging is nothing new when it comes to pharmaceutical companies. And these guys are the bad guys. But Hillary Clinton, I mean, she needs to distract in one way or another. We know what happened in Libya wasn't the best war that the U.S. has ever been involved in, or Canada for that matter. A lot of people blame Clinton for that. So, and her ties with Wall Street as well. So she has to kind of distract. Here's the shiny little object. Look over here, it's going to be pharmaceutical industries in her campaign. Yeah,
absolutely. And perhaps touring pharmaceuticals as well. We know Martin Shkreli, the former CEO of that company, wow, he dragged that company through the mud, unfortunately. But talking about black sheep companies and Clinton, Monsanto, that's another company that Hillary Clinton allegedly has very close ties to. Also a company in a bit of trouble right now. What do you know about that?
Yeah, Monsanto, they make seeds and they make poison. Oh, did I say poison? I don't mean poison. I mean herbicides, right? To kill herbicides. Roundup. Roundup's the big thing. Everybody's talking about that. Well, 5% hit. That's because they're saying that their earning projections for 2016 are going to be a lot lower than initially thought. Monsanto is not a company that is very popular among many people. This company is saying, first of all, the American dollar, the strength of the American dollar is one of the reasons that it's looking at a lower projection for this year, as well as the fact that farmers are tightening their belts, they're buying less seed. Also, one thing that people are tending not to look at are the many lawsuits against Monsanto, ranging from wheat all the way to Roundup, that herbicide I was talking about. There's a massive lawsuit going on in Europe right now. It's a bunch of NGOs are suing Monsanto, saying that the carcinogens within Roundup are actually a lot more lethal than Roundup or any of the scientists that they hired are willing to say. So Monsanto's in trouble. A lot of us, including myself, wouldn't mind seeing them get wiped out at one point or another.
All right, fair enough. We're going to have to leave it there. Alex Mihailovich reporting for us out of Toronto. Thanks so much for that.
Thank you.
It's already known that ISIS, the richest terror group in the world, has made a fortune from oil, taxation, and looting. But now the UK Parliament's Foreign Affairs Committee has learned that the group is earning even more money by playing the global markets. Boomba's Bianca Fascini has the details.
Even in the face of airstrikes and sanctions, ISIS has now niched a role in the global banking system. The latest figures show that the group is making $20 million a month. John Barron, chair of the UK Parliament's Foreign Affairs Subcommittee, explained that they're using money they stole from banks during their partial takeover of Iraq. He said the cash that ISIL has looted, along with siphoned off pension payments, is routed into Jordanian banks and brought back into the system via Baghdad. That allows the system to be exploited by ISIL, and that they take a turn on the foreign currency actions and siphon that cash back. The hearing of ministers was convened to investigate if and how the UK has had a role in the terror group's illegal finances. Tobias Elwood, a Foreign Office minister, said there was porousness in the banking system, but that they were working to shut it down completely. He also said that Iraq could have moved faster on this. In December, the Central Bank of Iraq listed 142 currency exchanges that the United States accused of transferring funds for ISIS. Though they banned them from dollar auctions, it doesn't seem to have had much of an impact. Daniel Glazer, U.S. Assistant Secretary for Terrorist Financing, claims there are more than 6,000 of these businesses in Iraq alone. And according to businessmen in Iraq, Jordan, and Turkey, more of these companies have popped up over the past year and a half due to the growth of the Islamic State. Even if there is a solid international effort to stop ISIS from affecting the markets, there's not much we can do about the money they've collected so far. Reporting in New York, Bianca Ficini, RT.
All right, time for a quick break, but stick around because when we return, Jim Rickards is on the show to talk about the Fed's struggle to end its experiment of low interest rates. Then in today's Big Deal, Ed Harrison and I are talking corporate earnings as they continue to drop the most they have since the financial crisis. How worried should we be about that? We'll discuss on the other side. Stay with us. And as we go to break, here are the closing numbers at the bell.
You're watching an RT America special report.
Man, it ain't about him. It's about you. It's about me. It's about everybody.
Basically, everything that you think you know about civil society had broken down.
There's always going to be somebody else one step ahead of the game.
We should not be in the business of normalizing violence.
We don't need people that think like this on our planet.
This is an incredibly tense situation.
I'm Tom Hartman, and I'll give you what the mainstream media can't, the big picture.
There's been no charges filed against him.
Preserve, protect, and defend. Political revolution. And when you question more, you find what you're looking for.
This is the legislative branch of the
We'll go deeper, investigate, and debate, all so you can get the big picture.
For decades, the American middle class has been railroaded by Washington politics. Big money corporate interest has drowned out a lot of voices. That's how it is in the news culture in this country now. That's where I come in. I'm Ed Schultz. I do the news on RT America. I'll make sure you don't get railroaded, and you'll get the straight talk and the straight news. Question more.
Welcome back to the show. To get his Fed insight, Jim Rickards is back with us. Jim is the editor of Strategic Intelligence, also the author of The New Case for Gold. One of his recent posts makes a clever analogy between the desperate attempt by Yellen's Fed to normalize policy and Casey Jones' runaway Cannonball Express from the turn of the 20th century. So Ed first asked him why, or what rather, he was trying to say about the Fed's ability to end this low-rate experiment. Here's what he had to say.
Sure. The metaphor I was using there, Ed, is basically we know what the Fed wants to do. Now, whether they can do it, separate issue. But what they want to do, and they told us in December, raise interest rates 300 basis points over the next 3 years, so 100 basis points per year, in small increments, which would be 25 basis points, at a slow tempo. So that would be, say, every other meeting. So that would be their preferred path. Based on that, with the December hike, you would expect that they would raise interest rates 25 basis points at the March meeting coming up very soon. And yet markets seem to have discounted that possibility completely. If you look at the Fed funds futures market, which, Fed funds futures market is interesting. It's not really a prediction market. It gives you a spot aggregation or summary of all the opinions in the marketplace today. But, it's very volatile. It can change. But right now, the Fed fund futures market is saying no way will the Fed raise rates. And yet in December, the Fed said, we're going to raise rates, and you should expect 25 basis points in March, in effect. So I compared this to a train wreck. You know, here's Casey Jones and the Cannonball Express. Here's a passenger train, and here's another train in the way. And what happened then in 1900 was they crashed into each other, and unfortunately, Casey Jones, the engineer, was killed. So what's going to happen this time? Three possibilities. One is Janet Yellen and the Fed will back off, kind of be guided by the market. The other one is that they will signal to the market that they're going to raise rates, in which case expectations have to adjust very quickly. The third possibility is the Fed raises rates, but the market doesn't adjust, and you have this train wreck. That could be very damaging for stocks. So you could have a shock on March 16th in which markets very suddenly and instantaneously have to reprice for an event which they were not expecting. So that's what I call the train wreck, and we could see a significant drawdown of stocks as we did last August and in January and early February. So that's the setup. So the question really is, will the Fed raise rates in March? Right now, my view is they will. That's way out of consensus. I know what the markets are saying. I know what a lot of commentators are saying, but I'm going by what the Fed said in December. In January, they did talk about some concerns, but they've given us no reason to think they won't raise rates in March.
Interesting, Jim. Let's go beyond March and say, what happens if the Fed, unlike Casey Jones, who died saving lives from the runaway Cannonball Express, what if Janet Yellen continues to stay on course for the full 100 basis points of hikes that the Fed's promised for 2016?
Well, I actually don't see any possibility of that happening yet. Now, if they do, the economy is probably on the edge of a recession anyway. A couple more rate hikes will be all it would take to, I think, put the economy in recession. By the way, I said on this program before December that I said the Fed would hike in December, that everyone's thought that, but I said it would be a blunder, that the Fed was tightening into weakness. So again, I said that before the December rate hike. It's exactly what happened. The Fed tightened, and we all know what happened to the stock market in January and February. It went down violently to, in effect, reprice for earnings declines and what would very possibly be a U.S. recession. So I see the Fed tightening into weakness. If they tighten a few more times, it'll make that worse. The question is, well, why are they tightening? The Fed's not supposed to tighten into weakness. They're supposed to ease when you have weakness. They're supposed to tighten when the economy gets too hot. The problem is that, I'm looking at real economic data, which looks pretty weak to me and to others. The Fed's looking at models. They're looking at, the Phillips curve and NIRU and some of these other models that tell them when unemployment is as low as it is and job creation is as steady as it is, that you shouldn't expect inflation right around the corner. They know monetary policy operates with a lag. They see steady growth, steady job creation. Some of the data, Atlanta GDP tracker, nowcast says that first quarter is going to be fairly decent. So, and we've seen a little bit of a pulse coming from inflation very recently. So those are all the reasons why plus credibility. Those are all the reasons why the Fed would hike rates. Nevertheless, continues to be my view, the economy is weak and they're tightening into what's probably a recession. So the question is, when does the Fed get it? I think a lot of commentators get it now. My expectation is the summer. So I think, as of now, I would say I give them a high probability of hiking rates in March. We'll see about June. I still have June on the table. I think they'll hike again in June. But by August, it'll be undeniable that the economy is probably by then in a recession. I think at that point they'll pause. But we're not there yet. I think they're still on the path to hike rates.
Now, you mentioned something about jobs there. That it's very interesting because we have a jobs report coming out, and that's going to affect how the Fed looks at the economy and whether they hike rates. What do you think is going to happen in terms of that jobs report?
Well, I don't know what the jobs report will say, but the way I think about it is, what would it take for the Fed not to raise rates? In other words, when I do an analysis, I always ask myself, what if I'm wrong, or what would it take for me to be wrong? So certainly if the stock market were to go, let's say, S&P 1650, that's down 15%. That's an earthquake. So if the S&P went down into the high 1600s, certainly to 1650, I would say the Fed would not hike rates in that scenario. On the jobs front, look, an employment report that produced fewer than 100,000 jobs, or where unemployment went up from 4.9% to 5%, that's the kind of thing that could give the Fed pause. Then I might update my forecast and say that the Fed will not hike in March. But my expectation, it's a wide range, but probably between 100,000 and 200,000 jobs. I don't want to pick that number. I'm making a different point. My point is anything north of 100,000, it may not be great, but it's good enough. So north of 100,000 jobs with the unemployment rate of 4.9% or lower. May not be great, but that's good enough to keep the Fed on track. So to me, that would be the litmus test.
Let me switch track here and talk about the G20. You know, we had a weekend meeting with the G20. Was there anything that actually happened at that meeting which bears noting in the context of what we're talking about here, Jim?
No, in terms of the kind of big picture global macro view we're discussing, Ed, nothing significant. In fact, the opposite was actually disappointment. A lot of people were expecting some more significant announcements. You know, I've recently had occasion to talk about the international monetary system personally with, Ben Bernanke, former chairman of the Fed, and John Lipsky, former former managing director of the IMF. And interestingly, these were separate conversations months apart on two different continents. And both former leaders used the same expression to define or describe the international monetary system. They said it's incoherent. Bernanke said it's incoherent. John Lipsky said it's incoherent. What it means is that there's no anchor, no rules. Like we gave up the gold standard a long time ago, but we were sort of on a de facto dollar standard from about 1980 to 2010. The dollar standard's gone. You know, exchange rates are volatile. The dollar's, gone up 20% in the last 3 years. I mean, that's extraordinary. Currencies aren't supposed to. That's a radical appreciation in a major currency like the U.S. dollar relative to its major trading partners.
Time, guys. I'm sitting here with Ed Harrison. We're talking about corporate earnings. A couple of months ago, we noted that U.S. corporate earnings growth had been down for 5 consecutive quarters, and that there had actually been negative. It had been negative, for 2 quarters in a row. But now we know that Q4 earnings were also down, making that 6 quarters of slowing earnings and 3 where they are negative. And Ed, of course, this begs the question: what's going on here?
Yeah, so what's going on? I would say that there are 3 things and then one thing that no one is talking about as much except for Jim Rickards. The 3 things are that, you have oil and you also have commodities, which is taking a big hit, and that's definitely taking a hit on earnings. But then you also have the strong U.S. dollar, and since a lot of these companies are abroad, they're obviously going to have weaker earnings that they're getting back into U.S. dollars.
Less people buying.
Right. And the third thing is that margin compression. Margins were incredibly high. They can't stay that high. So you have what's called a reversion to the mean of profit margin. So that's going to take its hit. But the last thing is obviously weakness. Economic weakness under the surface is definitely there. And when you combine those 4 things, that means you get 6 quarters in a row of declining earnings growth.
Yeah, it doesn't look good. And analysts, as far as I understand, are downgrading projections for Q1. That's what's very concerning as we start this new year. Forecasts have plunged 9.6% in the last 3 months, as we can see here in this chart, even with the dollar stabilizing. So the question is, what does it really signal about what trend we're on here?
Yeah, I think that, I would just reiterate what I was saying about the fact that it's not just these micro things. Okay, yeah, we have oil and gas, and yes, we have natural resources, and that's having a big impact, and the dollar has been strong. No, it's these other things. In fact, the dollar has actually stabilized. Oil prices have stabilized, and yet Q1 earnings are going to go down as well. So that tells you, at a minimum, we're going to continue to see mean reversion of these profit margins. And in addition to that, I would say definitely that the potential for economic weakness underneath the surface is definitely there, irrespective of the sectors that we were talking about. That means a spreading of economic weakness beyond just oil and gas.
How much of this do you think was at play when we saw the volatility in the markets in January and February? I mean, at unprecedented levels.
Yeah, I think that that's really what it's all about at the end of the day. I mean, when we look at what actually happened in terms of the S&P 500 or the Dow Jones, they peaked in May of last year. We had in August a sort of a correction. We also had another correction that you were talking about in January and February. And it's exactly at that time that we saw the 6 quarters in a row of declining earnings growth. So it's coincident with declining earnings growth. So what the market is basically saying is that earnings growth is going down. We have a fairly rich multiple in terms of our price earnings multiple. And as a result of that, we don't feel that these stocks going forward are actually going to be worth as much we don't feel that these stocks, the growth prospects are as much given the earnings prospects of those shares.
Well, here's what's really concerning. I mean, at the start of the year, analysts were expecting the S&P 500 to grow by 3.7% for Q1. Now they're saying S&P profit will decline by 1.9%. We went from growth to decline, quite a flip-flop. I mean, what does it tell us about what's ahead?
It tells us that there's going to be weakness ahead. And, let's look at some of the things that would cause that weakness. Two things that stand out in particular are global growth, and the second thing is the monetary conditions. Now, we just had Rickards on who was talking about the monetary conditions. He thinks that the Fed is still hell-bent on continuing to raise interest rates, even though that we see this. We saw San Francisco Fed head John Williams come out today saying that actually they're going to change their dot plot. And we all know that they're not going to change it up. They're going to change it down, meaning that their projections of how many interest rates they're going to have for this year are going to go down from 100 basis points in 2016, 17, and 18 to probably less than that. Okay, but that's still a headwind nonetheless. Then we also have global growth. We just saw recently, I think you reported on this earlier in the week, about the deflation and the things that are negative in Europe. That's actually something that was positive earlier, and so that's going to be something that is driving this. And we already know what's going on in the BRICS, particularly in China. So I think all of those things all combine to say that there are going to be headwinds going forward, and that we're not out of the woods yet.
And here's another metric I want to mention: price earnings multiple, 1.6 times higher than the rate at which analysts expect profits to grow, at least over the next 5 years. So what does that tell us? I mean, that they're richly valued, overvalued, at least compared to their potential growth?
Yeah, I think that's exactly right, because basically what it's saying is that, there's a normal metric in terms of the price-earnings ratio, and this is a high one compared to anything that you look since 1995. And what it says, therefore, is if you look at the price compared to the growth possibilities over the next 5 years, it's not good. So that means that probably you're not going to get as much of a return.
All right, and real quick, the question for investors: where do they go in this environment? What do we do?
I think there are three things. You could, go to cash. You want to avoid risk, reduce your risk, and you also want to lengthen maturities.
Okay, cash under the mattress. There you have it. That's the takeaway for me. Thanks so much, Ed. We love hearing from you guys. Tweet at all of us, Edward NH. Bianca Vashini, Amira David. And remember, you can see all the segments featured in today's show on YouTube, youtube.com/BoomBustRT. From all of us here at Boom Bust, we'll see you next time, guys. Thanks for watching.